dynamic coordinators, CA Rutvik Sangvi and Viren Tusi from Rajkot. And we have very learned encyclopedia speakers, and we have a opening bets person, CA Vishal Gada, who is a master on Fema. So please ask your queries frankly, boldly. We have CA Kuldeep Rathi. He is from Jodhpur, who will be assisting us this week for moderating these sessions. May I request? And one thing which I take up as a committee chairperson or as a council member is that progress of a professional happens by becoming a thought leader. And by thought leader, I mean the presence of a professional by speaking on that subject and by writing on that subject. So we have created a series of these webinars with an objective that each one of us take this opportunity to address the webinars, to write on a book of the topic on which we want to render more services. We do mentoring, we do hand-holding. We means ICAI and I myself personally, and ICAI pays 500 rupees per page. So if somebody comes out with 300 pages work, it is 1,50,000. Conditions apply, that work should be original, it should be acceptable to the committee, but it is worth doing all these exercise. And we encourage use of social media to reach out to the whole world, to all receiver of our service. So out of 800 crore population of the world, 500 crore uses social media. Now with these observations of mine, may I request CA Kuldeep to introduce today's faculty.
Thank you, sir, and thanks for encouraging professionals about these type of session and involving in institute practices. And good evening, everyone. I am CA Kuldeep Rathi from Jodhpur, Rajasthan. I am moderator of this webinar. Before starting today's session, I would like to apprise you about 21st World Congress of Accountants, which is going to be held in India for the first time from 18th November 2022 to 21st of November 2022. To know more about this, I would like to request our technical team to play a short informational video. Please see this and register yourself for the same.
Geographically, the 7th largest country in the world, one of the oldest civilization, world's 6th largest economy, a global hub for innovation with one of the largest startup ecosystem. India, city of Mumbai on the western coast of Arabian Sea, among the most advanced and modern metropolises in the world, and the financial capital of India, gears up to host the most prestigious accountancy event of the world, 21st World Congress of Accountants from 18th to 21st November 2022, an event held every 4 years. The Olympic of Accountancy Profession. India hosts the event for the first time in 118 years since the WCOA came into being in 1904. Around 10,000 delegates expected to join virtually. More than 6,000 delegates from over 135 countries would congregate to exchange views at the world's most advanced Geo World Convention Center. The theme, Building Trust, Enabling Sustainability, will inspire the future of accountancy profession to create sustainable economies for the future.
The ICAI is honored to be the host for this mega event, which will bring together the world's largest conglomeration of professional accountants, regulators, leaders, and visionaries to advance the cause of the global accountancy profession. Now, with the ease of travel restrictions across the world and the situation returning to normal, we are working towards creating a never before and a unique experience for all our delegates. The year 2022 marks the 75th year of India's independence, and the Government of India is celebrating the year in a big way to showcase the glorious history of India. World Congress of Accountants 2022 would also be celebrated as a mega event to showcase the important role that the accountancy profession has been playing in the economic and social development of the country.
A never before witnessed unique experience of learning future trends, emerging avenues, enhancing skill sets, networking, and to explore the incredible India awaits you.
We at ICAI are pleased to host you here in Mumbai, the financial capital of India, for the 21st World Congress of Accountants with the theme Building Trust, Enabling Sustainability from November 18 to 21, 2022, and give you a professionally enriching and personally rejuvenating experience. We are hopeful that the conference shall be stimulating and productive, and your stay in India will be a memorable experience. Once again, we invite you for this enthralling convergence in India, the land of multicultural, historical, and spiritual inheritance since centuries.
Insights from the stalwarts of the profession, international and national standard setters, regulators, and trendsetters will constitute the panel of speakers at WCOA 2022. Let your dream get bigger. Come, be a part of this mega celebration. For registration and sponsorship opportunities, contact. Organized by Institute of Chartered Accountants of India under the aegis of IFAC.
We are delighted to welcome you all in the webinar being organized by CECLA Committee of ICAI. It is my pleasure to be a moderator for this session on webinar to Complete Guide to Fema. In a short while, we will start this webinar. I would like to apprise you about CECLA Committee of ICAI. The committee, in line with one of the Institute's objective, partners in nation building and with a vision to contribute to economic development of India, aims to undertake such activities to technically equip, broaden the scope, expertise of the members to enable them to derive advantage in the rapidly changing scenario, and to enable the members to render various business advisory and support services. The program for this evening is understanding about the fundamental concepts of Fema, including how to learn Fema. From one of our eminent speakers, CA Vishal Gada sir. Vishal Gada sir will take the charge for explaining the same. Now, Vishal Gada sir, he is a qualified chartered accountant and has completed the business consultancy studies course conducted by Jamnalal Bajaj Institute of Management Studies jointly with the Bombay Chartered Accountants Society. He has over 20 years of experience in advising clients on tax and regulatory domain. He has worked on numerous complex merger and acquisition transactions, corporate organizations and regulatory issues. His area of expertise also includes devising succession structures, advising on domestic and international tax issues, and structures for inbound and outbound investments. He has co-authored a couple of books on professional subjects and is a regular speaker at various professional forums. Now, I would hereby request Mr. Vishal Gadasar to put some on light on the topic of the day.
Hi, Kuldeep, thanks a lot. I think it's my pleasure to, make this presentation on basics of Fema. And what I do, I'll put up a PowerPoint presentation, and maybe for the next 90 minutes, let me, share some of my thoughts. And if you have any questions, please put it into the chat box. I think happy to take it up at the end of the session. Let me share my screen. Kuldeep, you'll have to enable the screen sharing. I can't do that.
Tech team need to do this. Zigar, can you please enable the sharing screen option?
Yes, I'm able to do that now. Can you see the screen, Kuldeep?
Yes.
Okay, excellent. Let me put it up in full mode.
Okay. Yeah. Now.
So I think what we'll do is we'll today's topic is all about certain fundamental concepts about Fema, and we'll touch upon a brief on how to approach this very important subject, which I think is now becoming a very daily part of our professional lives. The way I've divided my presentation is, substantial slides are on background, where we'll talk a bit about fundamentals. I'm going to take up one topic, which is about, knowing the residential status, and then a couple of slides on, how do you approach this subject. That's how I thought I'll pace my 90 minutes today.
Oh.
Let me slightly go back, into history, and, really, exchange control was introduced in India in the British era. Like we had the first Defense of India rules, which were issued in 1939. They were issued on a very temporary basis. Thereafter, in the year of independence, we actually had a full-fledged act, which we were naming it as Foreign Exchange Regulation Act. And then that same act got replaced by an act in 1973 with the same name, which is FERA 1973. And obviously, it's very important to understand what is the difference between the old Foreign Exchange Act, which is FERA, and the current FEMA. And, a hint of what the old law was very clear from the preamble of FERA. It said that this is an act to consolidate and amend the law regulating certain payments, dealings in foreign exchange for the conservation of foreign exchange. If you look at the highlighted portion, the whole focus was that we want to regulate, we want to restrict foreign exchange payments, and we want to really regulate and conserve foreign exchange, resources of the country. If you therefore looked at, certain features of the old law, in addition to conserving foreign exchange, controlling foreign exchange, basically this law had a lot of criminal law angle. So it was a law where if you contravene anything, the implications were generally criminal in nature. There was significant prosecution for every small violation. And effectively, the act was very restrictive. It just didn't allow anything under the automatic route, and everything was then permissible basis the government notification and circular. The act presumed mens rea, which means if there is a contravention, it presumed that there was a guilt, there was a bad intention behind that action. And that was one of the reasons why the provisions were very, very penal. You actually had a lot of powers given to the enforcement agencies, which is, for example, ED. People used to be really scared about ED. And the regulators had extensive powers of search, seizure, prosecution, imprisonment, etc. So this was a law which was very, very criticized in the past. As distinct from that, you had in 1991 where the government really initiated this whole policy of economic liberalization. And around 8 years later, you had a new law, which was now known as Foreign Exchange Management Act. So they replaced the word regulation with management, which itself, I would say, seemed to suggest the tone of the new law. And this law became effective 1st June 2000. And if you look at the preamble, it was distinctly different compared to the preamble of the earlier law. This law basically said that this is a law which consolidates and amends the law with the objective of facilitating trade and payments. Look at the main object. The old law says that we want to regulate foreign exchange payment. The new law says that we want to facilitate trade. We want to facilitate the orderly development of foreign exchange market. It does not say that we want to regulate it. And this was where I would say, there was a sea change between FERA and Fema effectively. If I were to just compare FERA and Fema, I would say FERA is a controlling law. Fema is obviously a management law. FERA is a criminal law. Fema is perceived as a civil law. In fact, when it was initially initiated, there were no prosecution provisions. A couple of years later, on certain high-end contraventions, prosecution provisions were introduced. Till then, there were no prosecution. You just have to pay a monetary penalty. And under FERA, ED played a larger role, the enforcement directorate, whereas under Fema, Reserve Bank plays a larger role. These are some fundamental differences, I would say, between the two laws. The jurisdiction of Fema is that it extends to the whole of India, and it also applies to all branches, offices, agencies outside India, which is owned and controlled by a person resident in India. To that extent, there is a bit of an extraterritorial jurisdiction, but with all the right intention. So if I'm a company, I have a subsidiary outside India, I have a branch outside India, you might have the FEMA regulations even covering as to what can that branch, what can that subsidiary do about it. And it also applies to contravention committed outside India by any person to whom FEMA is applicable. Again, to some extent, it is slightly extraterritorial, but again, with all the right objective. So even if, let's say, your foreign branch, your foreign subsidiaries carry out a contravention, FEMA could reach out to such a contravention. If you look at the bare act, it's a relatively small act. It just has 49 sections. But basically, the substantive part of the law is regulated through various rules, various regulations, various circulars, various master directions, various FAQs, and various compounding orders. And of course, we'll touch upon it one by one in that sense. And what is the administrative framework, of this law? You have the Ministry of Finance, basically, which I would say overlooks the whole Foreign Exchange Management Act. There is a FIU unit, Money Laundering Financial Intelligence Unit under the Ministry of Finance. You have Reserve Bank, which is the operating administrator of FEMA. It is Reserve Bank which issues the APDIR circular. We'll talk about it a bit. It issues the consolidated master directions. It is also the approving authority in most cases, and it supervises the compliance of the act through authorized dealers, which is the banks basically. And you also have the Ministry of Commerce and Industry through its Department of Policy of Industry and Internal Trade. They issue press notes and press releases on the whole FDI policy. And obviously the FDI policy needs to be in sync with the regulations issued under FEMA in respect of inbound investments. So this is the overall administrative framework. There is also what you call an enforcement directorate, which works in parallel to Reserve Bank. And they come into picture if there is a significant violation, which has happened in the context of a foreign exchange regulation management act. A very quick if you look at the breakup of the whole act, section 1 deals with the jurisdiction. Section 2 is a very important section which talks about certain important definitions. For example, who is a person resident in India? Who is a person resident outside India? What is a capital account transaction? What is a current account transaction? We obviously will not be touching much upon capital account and current account. That is something which Rutvik will take in the second session. But section 2 really deals with some of these important concepts. Then section 3 to section 9, they talk about certain permissibility in terms of current account and capital account transaction. Broadly, the concept is that if a transaction is a current account transaction, it is generally permitted unless prohibited. And if a transaction is a capital account transaction, then it is generally prohibited unless permitted. That is basically, I would say, what these sections talk about. These sections also talk about the transactions which you did when you were a resident. They are presumed to be compliant even if you tomorrow become non-resident and vice versa. It talks a bit about export of goods and services. It talks a bit about realization and repatriation of forex. And each of this section basically then is expanded under a separate rule and a separate regulation which deals with the specific subject. You then have section 10 to 12, which talks about the authorized dealers, the authorized persons, which is basically the banks and their obligations and their duties. You then have section 13 to 15, a very important set of sections, which talks about penalties. If you contravene, theoretically, the penalties under Fema is as large as 300% of the amount involved. It's a very different thing that if you go for compounding of that contravention, the penalties are far more lenient per se. You also have this whole section about enforcement of orders of adjudication authority, etc. So 13 to 15 basically deals with penalties and compounding of orders. Then you have section 16 to 35, which basically deals with the overall appellate authority. So there is something called the adjudicating authority, which is nothing but part of the ED. How do you appeal against that order? Then you have an appellate tribunal. Then you have the position of a special director. So this is really the whole administrative come appellate elements of the whole Fema. And the last section 36 to 49 is where they basically talk about the powers of the enforcement directorate. As I earlier mentioned, the powers are substantially reduced, compared to the FERA Act. And then there is the power to make rules and regulations. This is the overall structure of the overall FEMA Act. But the substantive meat is all under the rules and under the regulations. And there is a separate rule, a separate regulation for each of the subject. Export of goods, import of goods, taking rupee loans, taking foreign currency loan, inbound investments, making investments abroad, you name it, and there would be a specific regulations and rules, which obviously we will be dealing in subsequent sessions. Today focus is more to talk about, the broad overview and fundamentals. It's very important. In two lines, we can basically say that what does FEMA attempt to govern? So FEMA attempts to govern any transaction involving a foreign exchange, a foreign security, or properties outside India by a person resident in India. Which means that if a person resident in India is dealing with an Indian asset, right, FEMA generally doesn't apply. But if a person resident in India is dealing with the overseas asset, overseas investment, overseas security, overseas properties, you suddenly have Foreign Exchange Management Act saying, wait a minute, let me see whether this is permissible or not. Similarly, Foreign Exchange Management Act deals with a person resident outside India who wants to invest in India, who wants to buy a property in India, who wants to buy a security in India, who wants to deal in foreign exchange involving Indian players, etc. Right? So this is how I would say it's a cross connection. I'm a person in India. What can I do outside? I'm a person outside India. What can I do in India? This is how the whole framework of the FEMA is. And therefore, moment you have a transaction which is a cross-border transaction, FEMA is the first regulation, FEMA is the first law which one would refer to really look at the permissibility of that. it's very interesting that generally, you have significant amount of rules and regulations, but the day-to-day administration is done via regular circulars and regular notifications. So, and we'll come to it, but you just don't have to look into the act. If it's an income tax law, almost 80%, 90% of the answers you will find in the Income Tax Act. Then you will go to the rules, then you will go to the circulars, right? The content is very, very limited in circulars, whereas 80% of the content is under the Act. Fema is almost reverse. Significant content is actually in the regular circulars which is issued, right? And minimum content is actually into the Act, which is providing a basic platform of how this whole Fema regulations needs to be administered. There are certain powers which are given to Reserve Bank. One of the most important power is that Reserve Bank is authorized to issue circulars on a regular basis to guide the authorized persons, which is the banks, in regard to any action of a cross-border nature. And these directions are issued by the Reserve Bank in the form of circular, which is known as APDIR series circular. So AP stands for authorized person, DIR stand for directions which are given by the Reserve Bank to that authorized person. So whenever you see a RBI circular which is titled as APDIR series, then this is a circular which is issued under the Fema regulations, Fema Act, Fema law, for the purpose of administering the whole concept of Fema in the country. Earlier, what used to happen is that if on a particular topic, Reserve Bank has issued, let us say, since 2000, because this law came into effect on June 1, 2000, and let us say there are 47 circulars on a particular topic of export of goods. Out of that 47 circulars, maybe 5 circulars would have been withdrawn or replaced by new circulars. It used to become very, very cumbersome for people to go and check every circular which has been issued. To ease that, what Reserve Bank used to do is every year they would consolidate the circulars and they will remove the circulars which have been replaced or withdrawn. And that consolidated document used to be known as master circular. And whenever, therefore, one wanted to look at the latest position on any topic, people would go and download the master circulars. Couple of years back, which is like from January 2016, this master circular was renamed as master directions. In substance, a master directions is again a consolidation of all the circulars. But one of the reasons why it was renamed as master directions was to give more authenticity to this document. Obviously, the standalone circulars, override, but we'll come to this aspect a bit later per se. So today, on almost every topic under the Fema law, you have a master direction on each of this topic, which has consolidated all the rules, all the regulations, and all the circulars which have been issued by RBI in that regard per se. You can go to the Reserve Bank website, and this is how the website will look like. You have to just type Reserve Bank Master Directions. And then when you go to the Master Direction circular, on the left-hand side, you basically have different aspects. There is a Master Directions on Banker and Debt Manager. There is a Master Directions on Cooperative Banking. If you see at the end, there is a tab which is Foreign Exchange Management. You have to click on that. And when you click on that, you will get into a detailed page where you will have a master directions on almost every topic, which is available in terms of Fema regulations per se. It's very interesting, but what Reserve Bank does is, in addition to master directions, the Reserve Bank also issues FAQs on a regular basis on multiple topics. And this FAQ is normally issued after a master direction is issued on a particular topic. And the purpose of an FAQ by Reserve Bank is to put in place the common queries which it receives and then give the regulator's view on some of these queries. So many times instead of interpreting a particular regulation, interpreting a particular rule, it is easier to go to the RBI FAQ page and understand that what is the Reserve Bank of India's view on that particular issue. And typically, if Reserve Bank of India has a particular view, we would not like to interpret it further or second guess further. Typically, people would adopt that view because unlike income tax, a FEMA is a very practical law. It's a very administered law. Where the intent of the regulator is more important, than any other aids of interpretation per se. So you also have this FAQ page, which is again on the RBI website. Now, when you practice FEMA, it's very common that sometimes the FAQ talks differently, the FDI policy talks differently, the master direction talks differently, the notification is a bit different. So it's important to understand that which overrides what. And let us first take FAQ. The Reserve Bank has clarified that if there is any inconsistency between FAQ and FEMA notifications or any master directions or any APDIR circular, then FAQ is inferior and FAQ cannot override the bare regulations or the master directions or the circulars. It's very clear that the FEMA notifications, the FEMA regulations, the master directions, the standalone APDIR circulars, they will always override the FAQ per se. So that's the first principle you need to bear in mind. The second thing is, we did mention that there is a FDI policy which is issued by the Ministry of Commerce on a regular basis. Again, it is written in that FDI policy that basically this policy is a summary of the foreign exchange inbound regulations, which technically is called Foreign Exchange Management Non-Debt Instruments Rules. So the consolidated policy clearly says that if there is any conflict between the FDI policy drafted by the Ministry of Commerce and the inbound regulation, which is Foreign Exchange Management Non-Debt Instrument Rules, then it is the rules which will prevail over the consolidated FDI policy. The consolidated FDI policy is basically nothing but it is an amalgamation or a consolidation of all the circulars. Here, obviously, and when you will talk about the inbound regulations in one of the sessions, many times it happens that the ministry comes up with a press release, with a press note on a particular aspect of FDI policy, which has not been incorporated in the FEMA non-debt regulations. And many times we would look at the latest policy, view it that, okay, this is the latest intention of the government. And many times, even though that new press note, new policy is not part of the non-debt instruments, we know that it is a matter of time that they will amend the rules and they will bring the rules in sync with the FDI policy. So this is something which on a case-to-case basis, you'll have to apply your judgment. And every time you have to ask, what is the current policy of the government? What is the latest policy of the government? And in that context, it might be very dangerous to take a view that if the government issues a press note on any FDI policy and you don't have a corresponding amendment made in the non-debt instrument rules, it's very dangerous to take a view that, I will not follow this press note, even though it is issued immediately. As I said, you have to take a very practical approach. In the past, the time gap between a press note coming and amendment in the rules or regulations would sometimes be more than a year. But fortunately now, the gap between such an amendment is reduced to a couple of months. So more or less, these regulations are always in sync per se. The third is the master directions, which I mentioned to you that it is nothing but it is an amalgamation of the law, the rules, the regulations, and the respective APIDR circulars. Here again, it's very clear that a master direction cannot override the bare regulations. So if a master directions talk about certain language, certain interpretation, which you do not find in the actual notification, in the actual regulations, then the actual regulations will override the master direction. A master direction is more like a guidance document, which has summarized, I would say, the law, the different circular for the benefit of, I would say, the reader. So as in when you practice FEMA, as in when you look into these documents, you will kind of form a judgment as to which document is more important compared to which document. That's very important, and this is a very important aspect. And I still remember, I was 20 years back a student of FEMA. I was actually looking at a particular a master direction, and there was some confusion. And my senior then explained me, wait a minute, if you have a confusion in the master direction, in those days it was master circular, go back, find the respective circular. It is possible that the amalgamation has not been appropriately drafted. If you still have some confusion in the individual circular, go back to the regulations and see that are the wordings conflicting. So that's the way how you will try to sync some of these documents together. And as I mentioned, ultimately every time the question to be asked is, what is the government policy? And that's how you'll find the right answers. So there are certain important sections, like and one of the most important players in the whole FEMA regulation is the authorized person, which is basically the authorized dealers. The authorized person or an authorized dealer, these terms are used interchangeably, and they're nothing but the banks who are authorized by the Reserve Bank to deal in foreign exchange. Every transaction you do, be it of a payment or be it of a receipt, as a fundamental rule, it has to be routed through the authorized dealers. You cannot do anything which is not routed through authorized dealers. I think it's very important for you to understand. And let me give a very, very simple example. Let us say you have a debtor outside India. You have exported goods to that person and you have to recover $100. That particular foreign party has a debtor in India from which that foreign party has to recover $200. The foreign party cannot tell its Indian counterpart that, what, I need to recover $200 from you, but I also need to pay $100 to somebody in India. Why don't you transfer $100 on my behalf? This can't happen as a fundamental rule, right? This has to be expressly permitted in one of the regulations, because the moment you design a transaction which does not involve an authorized dealer, right, you have to raise a red flag. You have to say, wait a minute, why is an authorized dealer not involved in this transaction? Something is wrong. Either it is expressly permitted in one of the circulars or regulations, and if you don't find one, then you will come to a conclusion, sorry, a transaction where I don't pass on money or receive money or pay money, where an authorized dealer is not involved, this is not something which I should do per se. So that's one of the most fundamental rule under FEMA per se. See, as I earlier mentioned, you have lot of materials which are drafted in the form of rules and in the form of regulations. Earlier, most of the rules and regulations were drafted by Reserve Bank. Couple of years back, they amended it where central government got the power to draft rules on majority of subjects, and Reserve Bank got the power to draft regulations on certain aspects. So if you look at section 46, it says that Reserve Bank has the power to announce rules on current account transactions, instruments which are determined to be debt instruments, permissible classes of capital account transactions, manner in which contraventions can be compounded, manner of holding an inquiry, which means the whole adjudication process under FEMA. Practically everything is now under the control of central government. If you go to section 47, Reserve Bank has the power to make regulations, but only on certain aspects. For example, it has the power to make regulations in respect of the period and the manner in which one would repatriate the foreign exchange back. For instance, if you have any foreign exchange due, generally the regulation says that you have to take efforts to bring that money immediately and in no cases beyond 90 days. That's under a regulation issued by Reserve Bank. Again, the Reserve Bank has power to issue a regulation on certain permitted classes of capital account transactions involving debt instruments. So you will see Reserve Bank coming up with regulations on ECB, external commercial borrowings, etc. So there are certain powers which have been given to Reserve Bank. But from our perspective, from a reader perspective, from a student of Fema perspective, it does not matter. You have certain subjects covered under rules. You have certain subjects covered under regulations. Rules are drafted by the government. Regulations are drafted by Reserve Bank. They never overlap. They work in tandem. And you have to find the relevant rule or the relevant regulation which deals with the problem on hand, and then find an answer as to is that transaction permissible or not, and if yes, what are the conditions attached per se. But it's important for you to know what is the distinction between rules and regulations. In effect, both are same. Former issued by the government, later issued by the Reserve Bank. Section 15 is a very, very important section on compounding. And what is a compounding? It effectively is a process where if somebody inadvertently contravenes any of the Fema law, act, rules, regulations, then you can suo moto go to Reserve Bank via your authorized dealer, and you basically file an application. You admit your contravention, you admit your guilt, and you say, sorry, I'm really sorry for this contravention. Reserve Bank will then verify this. They will constitute what you call a panel, which will look into your application, and then they will say, okay, we accept your apology, and this is the fine which you have to pay. And as I mentioned, while theoretically the income tax, the Fema regulations, talk about a fine as high as 300% of the total amounts involved. A compounding process is very lenient. Many times the fine is just 1 or 2% of the total amounts involved. And one of the best thing which Reserve Bank has done it is that all the compounding orders, now it is putting on public domain. So if you go to the Reserve Bank compounding order website, you're also able to look at the nature of compounding, the circumstances under which RBI took a particular view, and the adjudication which RBI does. So it's a very, very important aspect, because inadvertently you will see, our clients making some or other contravention for which they might have to go for compounding. So the whole power to compound is under section 15, and there is a separate rule which has been issued by the government, which is called the compounding rules, which gives the whole framework as to under what circumstances you can go and kind of compound your contravention per se. I think we also have a separate session on this. Now, this is a very interesting section. It's section 37A. And at the start of the talk, I did mention that generally Fema is a civil law. Generally, for any contravention under Fema, you don't really need to fear about any prosecution, any imprisonment. Generally, it's a monetary fine. But there are certain exceptions to that rule. And one of the exceptions is section 37A. So under section 37A, there are certain powers given to the enforcement directorate, where if you have acquired any foreign exchange, any foreign security, any foreign immobile property in contravention of, I would say the Fema regulations, then they have the power to forfeit those assets. And if they are not able to forfeit those assets outside India, they will forfeit an asset in India of an equivalent value. And these sections, read with section 13, are the areas where the power to levy a prosecution is there. And it's very important to ensure that, we do not fall foul of some of these provisions per se. And let me give an example. There have been certain publicly reported cases where certain individuals bought properties, residential property overseas via a structure where a company was created. That company took a view that, I am in certain trading activities and I am buying this property as a guest house for my directors. And enforcement directorate took a view that this is a sham transaction. Effectively, there was no concept of a guest house. This was a personal residential property which was bought in by the individual via a dubious structure. and therefore they initiated proceedings under Section 37A. They attached, because they can't attach the foreign property, they attached properties equivalent to the value of that foreign property, and then they initiated proceedings against those individuals and those entities involved. This is one classic case where you have a risk of a prosecution per se, and obviously this whole Section 37A is administered by the Enforcement Directorate wing and not by Reserve Bank. So obviously, they have a more aggressive approach to some of these, I would say, contraventions. It's very interesting, but Reserve Bank has come up with an FAQ, which says that the cases attracting special provisions under Section 37A shall not be eligible for compounding. And of course, we'll discuss that in more detail in one of the sessions. But the gist of this FAQ is that RBI will not intervene in the attachment proceedings of that concerned Enforcement Directorate. It does not mean that you can't contravene the principal contravention. This Section 37A merely talks about the attachment proceedings, which obviously you can't contravene, which means under no circumstances can you stop Enforcement Directorate from attaching the assets by going under compounding. RBI says, sorry, we will not intervene under an attachment proceeding per se. But in my view, it does not stop somebody from going under a compounding process to request compounding of the original contravention which has happened. It's a different thing that internally Reserve Bank will give an opportunity to the Enforcement Directorate as to whether you have any objection or not to this request of compounding before which I compound. But there are lots and lots of interesting issues around this, which will be dealt with in separate sessions. See, these are some important Fema regulations and rules I have listed down. These are not exhaustive. These are just illustrative. For example, certain regulations, you have this transfer or issue of any foreign security regulations. This talks about outbound investment. When you want to invest in a foreign company, this is the regulations which needs to be referred. Then there is foreign exchange management, borrowing and lending regulations. Whenever you want to lend and whenever you want to borrow, you basically will rely on these regulations. Then you have the export of goods and services regulation. Whenever you want to export goods, what is the credit period, within what period should money come back, etc. Everything will be documented under these regulations. Then you have the permissible capital account transactions. It's a very short regulation, but it gives the concept that unless something is permissible, capital account transactions would generally be prohibited. So it's interesting to read this short regulations, which then refers you to a detailed set of regulations. Similarly, if you look at certain important rules, you have this non-debt instruments rules. This is nothing but basically inbound regulations. Whenever a foreigner wants to invest in India, a company wants to invest in India under the FDI route, under the FPI route, under the NRI route, there are so many routes available. You will basically go and look at non-debt instruments. There is this compounding proceedings rules, which I've mentioned. There is this current account transaction rules, which you will take up in the second sessions, which broadly seems to suggest that almost everything is permissible except certain transactions for which you will require RBI approval. So these are some important regulations and rules. You have master directions for each of them. You have separate APDIR circulars for each of them, which are obviously also consolidated into the master circular. You also have the FAQs, which highlights certain issues and Reserve Bank of India's views and response on each of them, which means that if you merely refer Fema Act, you will not get the answer. If you merely refer a regulation or rules, you will not get the answer. If you merely refer a master direction or a APDIR circular, you will not get the answer. If you merely refer an FAQ, you will not get the answer. You'll have to read everything together. And when you read everything together, hopefully you will come to the right answer that yes, this is permissible, this is not permissible, this is permissible subject to X conditions, etc. And of course, for any issues, you will go to your banker saying that this is my interpretation, is it correct, is it not? And they will guide you on that. Now, with this, what I want to do it is, maybe spend, the next half an hour on a very important concept, which is the residential status. And after that, and we'll pick up few case studies, and after that, at the end, we'll talk a bit about the approach to learn Fema, and then of course we will, go to the chat box and look at the questions. I think that's how we'll spend the next 1 hour. So it's very important that the first rule you should understand is that FERA used to refer to an Indian citizen and a foreign citizen. An Indian citizen could do many things. A foreign citizen could do very limited things. The concept of citizenship is generally not relevant under FEMA. What is relevant is that are you a resident or are you a non-resident? As an Indian citizen, if I am non-resident, then many of the transactions I may not be able to do, which are available for a resident. For example, if I become an NRI, right? I am still holding an Indian citizenship. I'm still holding an Indian passport, but I cannot buy an agricultural land moment I am an NRI. There are restrictions on that. But interestingly, if you have, let's say, a foreign citizen coming and being based in India and he becomes a resident, he can do anything. He can play in the stock markets, as a resident. There is no stopping. So it's very important. What is your residential status? And as I said, it's not linked to your citizenship anymore. The second important concept is that unlike Income Tax Act, where a residential status is linked to a financial year, like you cannot say that for 3 months under tax, I am a resident and for 9 months, I'm a non-resident. Sorry. April to March is our financial year. Under tax, either you are a resident or you are a non-resident. In worst case, you could be resident but not ordinary resident. But you cannot have multiple status in a single year. Under FEMA, there is no concept of residency for a year. It's always residency at a point of time. So whenever a client asks you, can I do this today or not? And the regulation says that a resident is permitted to do it. At that point of time, you have to evaluate, are you a resident today? It's possible that your residency may change next week. You get a job in US, you pack your bags, you take a flight to New York next Sunday. Today you are a resident as we speak, and next Sunday you become a non-resident. All the transactions that you do today as a resident, they are all validated. Moment you become a non-resident, there are many transactions which you cannot do. So it's very important to remember that the residency status is always at a point of time, and it cannot be a financial year wise residency. And it is quite possible that in a year you have mixed status. For certain periods you are a resident and then you become a non-resident, or vice versa person. So let us get into this whole concept of residency, and then we'll pick up few case studies, to understand that. And we'll also see some of the practical views being taken, which are in, I would say, a variation to what actually has been drafted in the definition of residency. So what is defined in detail under section 2 of FEMA is who is a person resident in India. There is another definition about a person not resident in India, which simply means that a non-resident is a person who's not a resident. So if you do not qualify to be a resident under this definition, then you automatically become non-resident. The principal condition of becoming a resident is that in the preceding financial year, you have to be in India for more than 182 days. That's the first principal condition. And you have to satisfy certain conditions. For example, being in India for more than 182 days in the preceding financial year, you should not have gone outside India for employment, or you should not have gone outside India for carrying on any business or vocation, or you should not have gone outside India, which indicates that the purpose of your stay outside India is for an uncertain period. And let us take an example. Let us say I have always been in India. I have never traveled abroad in my life. Let's presume that. So last year, definitely I was in India for more than 182 days. Today, as we speak, I am a resident. And let us say I get a job in London and I go out next week, to take that job. The day I leave India to pick up that job, I technically become a non-resident. So even though I satisfied the principal condition of being in India in the previous year for more than 182 days, I did not satisfy the conditions that you should not have gone out for employment. Similarly, if I go outside India for starting my own business or any vocation or profession, I again contravene the sublime of this. And therefore, even if I'm in India in the previous year for more than 6 months, moment I go out for carrying out any business, it means that, hey, I've become a non-resident. And going out for carrying out for business does not mean going out for business tour. I can go out for 15 days for a business meeting and come back. That is not carrying on business outside India. That is going outside India for a business purpose, which you are carrying from India. So carrying on business outside India means you are now setting up a business and you are now going to take charge of that. Similarly, and this is interesting, any other purpose indicating your intention to stay outside India for an uncertain period. Let us say somebody is, going for education purpose. That education would take at least 4 to 6 years, I do not know. I might then do a graduate. I might then do a major. I might then do certain degree course. So moment I go out, the question is, can I argue and build up a case that, I'm not going out for employment. I'm not going out for business, but I'm going out for a purpose which I do not know, when will I come back? Right? It could be 6 years, 10 years, 8 years education. I really don't know. Maybe I'll qualify as, so it's a very subjective test, right? There is nothing written in black and white. It depends on the intention. If your intention is to stay abroad for an uncertain period, right? You become a non-resident, even though if in the previous year, you actually have, stayed in India beyond 6 months. Let's say somebody is suffering from a terminal disease and doctors have said, you have to be in US, you have to go to this Hopkins hospital where the latest medical technology is there. And we do not know, when will you be back? That could be one reasoning which can be made to the bankers saying that, I do not know. My friend is suffering from a terminal disease. This could take a year, it could take 2 years, it could take 2.5 years. I do not know when we will be back. So I'm really outside India for an uncertain period. I could be regarded as a non-resident. So it's a very, very subjective test. Somebody gets married. Now after marriage, that person is living abroad with his or her spouse. That person who has gone out has not gone out for employment, has not gone out for business. But obviously now that person is living with his or her spouse. So till the spouse is working out and being based out, this person also will be attached and will be staying out. So again, his stay outside India is for an uncertain period. So there could be umpteen number of facts. Somebody has gone to Tibet. Somebody says, I want to really get into spirituality. I want to attain self-realization. I do not know, but I will meditate for many, many years. I'm going out for an uncertain period. I do not know when I will come back. So there could be infinite possibilities. There could be infinite facts, infinite circumstances. And ultimately, it all depends on the intention. So this is the first limb, that you should be in India in the previous year for 6 months, but you should not be going out, for employment or for business or for any other purpose which indicates an uncertain period of stay outside India. At the same time, a person residing in India for less than 182 days, if that person comes in India for employment in India, for carrying on business or vocation in India, or for any other purpose which indicates an uncertain purpose or uncertain period of stay, absolute reverse. But it's very interesting. The manner in which the section is worded is very different compared to how it is administered. And let me first take you through how the section is worded. Under the section, the principal condition of 182 days is not relaxed. So anybody who wants to be regarded as a resident needs to demonstrate that, I was in India for 182 days in the previous year. Sorry, more than 182 days in the previous year. That is a principal condition. And clause B, which applies to persons who come to India, right? Theoretically, they also have to ensure that they were in India in the preceding year for 182 days, and they have come to India otherwise then for taking up employment in India, which means that if they satisfy the 6 months period, but they are not in India for employment, they are not in India for business or vocation, or they are not in India for any purpose which indicates a long-term period of stay, then they will still not be regarded as a resident. But the manner in which it is drafted has not taken away the principal condition of 182 days. But very interestingly, in practice, moment somebody comes in India and settles here. So if you have an NRI who's staying out for India for the last 10 years, and then he says, you know what, forget it. I'm just coming back to India. Now I will settle in India. We have seen bankers taking a view that they become resident immediately. So this is an interesting aspect and which you should always be aware of. The difference between what theory says and what in practice Reserve Bank implements via the banks. And you will have many, many such cases where the practical implementation of a particular provision may not always fit into the manner in which it is drafted per se. And the definition of residency is one of the classic case. Because if today, let us say an NRI comes to India in December 2022, right? December to March 23, he cannot be in India for 182 days because that's just 4 months. So clearly in financial year 22-23, he cannot become a resident if you strictly go by this definition. Then you come to the next financial year, which is financial year 23-24. When you want to test whether he's a resident, the section says, you know what, look whether he was in India in the previous year for more than 182 days. Now, in the previous year, he was only there for 4 months, which means the whole of 23-24 also he will not be regarded as a resident. Because in the previous year, which is financial year 22-23, he came to India from December and stayed just for 4 months. Now you come to 24-25 financial year. Now somebody would say, okay, I accept, right, that you are now a resident, because in the previous financial year, which is 23-24, you finally stayed in India for more than 182 days. So if you theoretically look at this section, it might lead to a scenario where an NRI coming back to India for good actually becomes a resident in the third year. So he came in India in financial year 22-23, which is December 22, right? But the first 2 years he could not satisfy being in India for more than 182 days in the previous year. And therefore he had to wait all the way for financial year 24-25. But you know what? In practice, bankers do not look at it. In practice, Reserve Bank doesn't seem to look at it. Moment I come to India and moment I am here for a very, very long term, I'm settled here. I say, fine, I'm not going to go anywhere, at least today. They give you a residency status by allowing you to open a normal resident savings account. So it's very interesting how in practice, certain aspects, which are very important aspects, work compared to how theories per se. And we'll obviously take, as I mentioned, few case studies per se. As regards a non-individual, it's pretty simple. If you're a company, then it depends on your incorporation. If you're incorporated in India, if you're a partnership firm, you're registered in India, then you are basically a resident in India. Otherwise, if you're a foreign company, you're a foreign partnership, you're registered outside India, you are basically incorporated outside India, then you are a non-resident. There are some practical challenges on HUF, right? How will an HUF become a resident in India? Because the definition does not talk a bit about HUF. Different bankers have different views. Many times the banker says that, you know what, where is the majority of the family base? Certain banker says that, no, I want to look at Karta. So it's all a mixed practice and you will never get a clear answers. And that is where I would say Fema is a practical law. A lot depend upon what interpretation your bankers take in consultations with Reserve Bank per se. I think with this, let us take some case studies, which will be interesting. So, we have Mr. A Mr. A has always been resident in India, right? Never gone abroad. Now on 31st May 2021, he gets a job in US. So he's gone to US to take up employment. And clearly, if you look at the previous year, which is financial year 2021, he was in India for more than 182 days. The question is, what is his residential status for the whole of financial year 21-22? As I earlier mentioned, the question is wrongly drafted. There cannot be a residential status under Fema for a year. The residential status can only be at a point of time. And here maybe one can argue that from 1st April 2021 to 31st May 2021, that person was in India and hence a resident. And maybe from 1st June 2021 onwards, because that guy has now been employed in US, that person becomes a non-resident person. So your answer will be for a period of time, and at that point of time, whether he's a resident or non-resident. So this is a relatively simple case study. Let's take the reverse, which is most interesting. You now have somebody who's a US national, who's a US citizen, and he comes to India for employment with an Indian company, and he comes to India in April 2018. And let us say he's likely to be here for a very long time. It's very interesting. And of course, he continued his employment till 31st December 2021. But obviously, you never knew when he came to India in April 2018 that what was his intention to stay here. The question is, if somebody asks you, what is his residential status for financial year 2018 and 2019? If you look at how the definition is worded, you will say, you know what, look at the previous year, which is financial year 17-18. In the previous year, he has not stayed in India for more than 182 days, so he has to be non-resident. However, in practice, if you tell a banker that this guy is now in India for a long term, he's in India for employment, they immediately give you the residential status. And how do they give you the residential status? There is no concept of a certificate. There is no concept of some residential permit being given by the bankers. They merely allow you to open a resident savings bank account, and which would mean that they would now allow you to do whatever you want to do now that you are a resident, which a resident can do. See the divergence, because if you look at the law, you would say, you know what, for 18-19, he's not a resident. Now let's go for 21-22, financial year 21-22. Now in financial year 21-22, it is divided in two baskets. April to 2021 is the first period. April to December 21 is the first period, and 1st January to 31st March 22 is the second period. Now here, if you look at the approach which bankers take, you will come to a view that for the first period, he is a resident in India because he was in employment in India. And because he left India permanently on 1st Jan 2022, from that date, he became a non-resident because he has now gone abroad for an uncertain period, whatever you want to call it per se. So that's how you will break it up into periods to say that, you know what, for this period, he's a resident. Then for that period, he's a non-resident. In this case, even if you were to employ the previous year concept, you might still come to the same conclusion, because if in financial year 21-22, you want to look at, you know, what was he in the previous year, which is financial year 2021, then he was obviously based in India for the whole of the year or majority of the year. So here, whichever way you look at the theoretical approach as per the definition, or you look at the practical approach which bankers take, which I don't think Reserve Bank really objects to. In both cases, he's basically a resident up to 31st December 2021, and thereafter he's become a non-resident. In practice, what is the general view? People adopt the theoretical view or people adopt the practical view? Answer is people adopt the practical view. Nobody really looks at the previous year 182 days, which is obviously a mystery, but that's how it is, I would say, practice today. Let us take one more case study. This guy is a resident of USA. He comes to India on 1st June 2020 for visiting his parents, which is COVID time. But his parents, kind of fall sick. And so he extend his stay, till 31st March 2021. And while he continues, it is very certain that he is here for a temporary period, because he will leave as soon as his parents will recover, right? There is no other contingency here. He is not in India for employment. He is not in India for business. And also, because he is very clear when he will leave, he is not in India for any uncertain period, because it is very clear that he is here for this much time and he will leave immediately. What would be the residential status of Mr. A? In my view, he is obviously a non-resident. He might stay in India for 12 months. He might stay in India for 18 months, but that does not change his intention. That is not in India for employment, is not in India for business, and is not in India for an uncertain period, because his intention is not to stay here. His intention is to maybe wait till his parents recover and go back. So you therefore see that the concept of residency is a bit subjective. It is a bit intention driven. It depends on so much of facts which has to be brought on the table to really determine whether that person is resident or not. And once you determine whether the person is resident or not, that is the starting point on now whether this person can do this or not. For instance, if you decide that that person is resident, and the next question is that can I invest in the stock markets now that I'm a resident? You don't have to look under Fema. Fema regulations do not deal with residents investing in Indian stock markets. You will never find any regulations which deal with that. But if you're a non-resident, there is a regulation under non-debt which says that under what circumstances can a non-resident invest in Indian stock market. So therefore, the concept of residency and non-residency is very important. A resident investing in Indian matters, you don't find anything in FEMA because the law does not restrict. A non-resident investing in foreign market. So in this case, this Mr. A, we have concluded that he was always a non-resident because he was not for employment, business, or an uncertain period of stay. He investing in US market. Again, if he comes and asks you, what I'm staying in India, can I invest in US markets, which I always used to do? Your answer is, what? FEMA does not care. You're a non-resident. You're investing in a foreign market. I'll never have any answer in FEMA because it does not deal with that scenario. It does not intend to govern that scenario. And hence, the starting point of many of the questions would be that, are you a resident? Are you a non-resident? And of course, and then you will go to the respective questions, respective regulations, respective rules, respective master directions, respective FAQs, and then come to an answer per se. So I think with this, what we do is, we have covered certain basic concepts under FEMA. We spoke about how the structure of the act is. We spoke about the concept of master directions. We spoke about the concept of APDIR circular. We spoke about FAQs. We spoke about rules. We spoke about regulations. We saw certain illustrative rules, illustrative regulations. We talked a bit about compounding. We spoke about what overrides what. Obviously, Act is supreme. Rules, regulations override the circulars. FAQs are cannot override the rules and regulations or the master directions. It's always the other way around. And then we came to one of the most important concept under FEMA, which is residential status, because that's the starting point before you get into any of the definitions. We looked at the theoretical approach of 182 days in the preceding financial year. And then we looked at the practical approach which bankers take, in my view, with implicit blessings of Reserve Bank. Where moment you are in India for employment, for business, or for an uncertain period of stay, they deem you to be a resident immediately or a non-resident immediately. We also spoke that, residential status under FEMA is not linked to a financial year. It is linked to a point of time. So at every point of time, one needs to determine, are you a resident, are you a non-resident, etc., before which you come to a conclusion. So this is what I think we covered in the basics of FEMA. What we'll now do or talk a bit, we have 45 minutes, it's already 5:15. So maybe for the next 15-20 minutes, I'll talk about how you might like to approach FEMA as a student. And then, we might get into questions if there are any per se. So as I mentioned, the first step would be that you need to strengthen your basics about what is a residence, what is a non-resident, what is a current account transaction, what is a capital account transaction. The other two is something which Rutvik will take up. It is very, very important because moment you say I'm a resident, I effectively can do anything in India. To do something outside India, I need to be governed by Fema. And if I'm a non-resident, I effectively can do anything outside India. But to do something in India, I need to be governed by Fema. Similarly, we discussed very broadly current account transaction generally permissible under automatic route unless prohibited. Capital account transaction generally prohibited unless expressly permitted. But of course, there are nuances to this which Rutvik will take up. So I think these concepts are the most important concepts under FEMA before you take it up. Thereafter, you need to pick up a specific topic and go deep into it. You want to know more about inbound regulations, pick up the non-debt rules, pick up the master directions of non-debt, pick up the FAQs of non-debt, go deep into it, read it, analyze it, understand it, look into the history of the circulars, how they have modified. That's it. You want to know more about export of goods, pick up the export of goods rules, go deep into it, pick up the relevant master directions, read it, pick up the relevant FAQs, read it. That's how you will pick up and master that subject. You want to know more about purchase of immovable property, pick up that specific regulations which talk about when can non-residents purchase immovable property in India, in what circumstances, go deep into it. You want to know more about ECB regulations, go to the borrowing and lending regulations. Again, go deep into it, etc. I think that's the way you'll have to, I would say, build up your theoretical knowledge. And it's very important that you cannot do a theoretical interpretation. Whenever you are doing or studying an income tax act, right, you will strictly interpret the way the wordings are. There is no concept of equity in a tax law. You will not see whether it is logical, illogical. You will typically apply the golden rule, which is the rule of literal interpretation. But FEMA is absolutely different. It's a regulatory law. Intent matters more than anything else. Something which you believe is illogical, even though the wordings are saying pause there. Question yourself, is that the intent? Discuss with your bankers. They will informally discuss with Reserve Bank, is this view possible? But anything, which is innovative, out of the box, you cannot do regulatory structural planning under FEMA. There are very limited avenues, unlike Income Tax Act, where you will do certain innovative tax planning. So unlike Income Tax Act, where you cannot find what the intent is because you can't go and ask CBDT, under FEMA, you have an ability to check with Reserve Bank via your bankers. Reserve Bank will never entertain your queries directly. Always have good relationships with your bankers, interact with their regulatory team via the relationship manager, frame the right questions, understand the intent, understand the current practice, and those practices could keep on changing. I'll give you an example. 10 years back, there was this whole fear of round tripping, right? Which meant that an Indian company investing in a foreign company and foreign company investing back in India is something which Reserve Bank is not comfortable with. But there was nothing under regulations, nothing under any literature. So you had a mixed view. Certain banks would say, you know what, it's a legitimate round tripping. You can do it. Councils would say, inbound regulations don't stop it. Outbound regulations don't stop it. You could do it. Somewhere a few years back, Reserve Bank said, you know what, I am now issuing an FAQ. The FAQ basically says that any ODI investment in an overseas entity cannot have a step down investment in India. After that, people started taking a view that, sorry, I can't even do it, even if that's not an abusive round tripping. So the approach changed, the interpretation changed. And in the past, people who had done it and where RBI noticed it, RBI used to take them for compounding, etc. And of course, they were lenient about it. I don't think they were harsh on many of these round tripping structures. But the important point I'm trying to make it is that today, what approach you take, there is no guarantee that tomorrow, without change in law, the same approach may not be questioned. And this is, I would say, the dynamism about FEMA, where you have to be updated of what is the current view of the bankers, of Reserve Bank, what is the current practice. And that's where you'll take a judgment that is the risk worth it, to kind of take this particular step or not. Is this interpretation right? What if tomorrow it goes wrong? Another example I can give you. You have so many startups who want to create a US company so that the valuations are high, and the US company would obviously form an Indian subsidiary. But it's again a round tripping. How many of them do it? They find a relative will form a company, the company will gift the shares. And then they create these round tripping structures. And their argument is that, you know what, I've received gift of shares, which is permissible. I have not sent out a single penny. If I don't have a relative, I'll get a friend to create that structure. Some bankers are okay, some bankers are not okay. Now you suddenly have a draft regulation which says that we will not permit any non-relative to gift you the shares. The question would be, what happens to the old structures? Is it legitimate, not legitimate? That's where I would say the dynamism comes. So you always have to be updated with the current intent of the regulator. What is the discomfort of the regulator? And that's where, in my view, a constant interaction with the bankers help you get a sense about what is happening. One of the best thing which RBI did is it put up the compounding orders in public domain. Of course, not very good for the people who are involved in compounding. But if you analyze the compounding order, you get a sense of the views taken by Reserve Bank. It's a different thing whether you agree with those views or not. But at least reading the compounding order, that in that particular case, the RBI took X view. And because it took X view, you exactly know that if you do something similar, you are going to face the same music. And I do not think that people would like to appeal to RBI's order against high courts and all. Nobody does that. That's not how legally can you do it. Answer is yes, absolutely. Wherever there is no such specific mechanism in the act, you can always go and file a writ in the high court, but nobody does it. As I mentioned, FEMA is a very, very practical law. You'll be more concerned about how a Reserve Bank looks at it than your own interpretation per se. So this is where I would say an analysis of the compounding order is very, very, I would say, important. I know it's hard work going and tracking the website every day for new orders coming in, but there are no shortcuts. Most important, consulting your bankers, telling them that, what, I have this issue, I have this view. Is this view right? Is this view wrong? And it's not that if the bankers give you a view, even if in writing, that you are safeguarded. Tomorrow, if Reserve Bank believes that that's the wrong view, you may still have to go for compounding. But at least you have taken all the necessary steps, I would say, to kind of understand what is the potential interpretation. I don't think Reserve Bank will really hang you if you have got AD Bank and you've basically gone ahead. And let me give you one more example. Many years back, we had this case where a notice was issued by RBI to a company, and Reserve Bank said that, what, this investment is in a real estate abroad, and under the outbound regulations, you cannot invest in a real estate sector. The company said that I have been told by my bankers in writing that I am buying a property and I am basically leasing that property out, which is not a real estate, and it's perfectly fine. Reserve Bank said that maybe we don't agree with that, because that dispensation we have only brought in the inbound regulations and not in the outbound regulations. So you please come for compounding, and we'll compound the offense. But you will have to undertake that process. A written clarification by the banker was shown to the Reserve Bank, but Reserve Bank said, sorry, we disagree with that. We have never issued any such clarification. However, the fact that the client, that company did everything, Reserve Bank was very, very lenient on that company, saying we understand that you were guided or misguided by the banker, but nonetheless, we have to rectify that. So it's always good many times that you might keep counsel opinions on record. You might go and get AD bankers clarification, conserve those emails, but more importantly, keep on consulting with the bankers. That's the best way to understand that what is the current legislative intent as expressed by RBI's views. I would say RBI's view is certain under FEMA. You will not second guess that per se, right or wrong, but you will try to ensure that your view and your implementation is very near to the regulator's view. That's how you will make lesser mistakes per se. And unlike Income Tax Act, where we are not supposed to follow the law in spirit, there is no equity and tax, as they say it. FEMA is very different. Try to understand the spirit. Something which you cannot do directly, you can't come up with a mechanism to do it indirectly, right? So better sometimes to be conservative under FEMA, unlike Income Tax Act and all that. And I would say these are some of the guidelines where hopefully if you do it on a regular basis, right, you should be able to become a better student of FEMA. So there are no no complete books. There is no Sampath Iyengar commentary. There is no Nani Palkiwala commentary. There are some beautiful books written on FEMA, let's say by Mr. Dilip Sheth and some other authors, which obviously you can refer. But the law is constantly changing. Regulations are constantly changing. Circulars are issued. Old circulars are getting replaced. Policy is being changed. RBI is coming up with a new ECB framework. There are new rules on hybrid instruments. What not? As we speak, in a couple of weeks, you will see a revised outbound regulations being issued. It's on its way. So things are so dynamic that you will never find a single book which covers everything. And therefore, the best way is obviously to keep on discussing with your bankers, and via your bankers consult RBI informally that this is the view we are taking. Is it correct or not, per se? I think this is, in my view, how you would become a better student of FEMA and keep on, I would say, constantly learning. So I think with this, I complete my presentation, Kuldeep. I think we have some 30 minutes left.
Yeah.
So very happy to, get into questions and answers around it.
Okay, now we are taking with question and answer. So first question is from Milandu Cherian Sajman from Kochi. He has a couple of questions. Can a private company accept deposits from NRI director from NRO account on non-repatriation basis for a maturity period of 3 years?
So I'll give a very short answer while you have a separate session on some of these. Whenever any loans are given, they are basically covered under the ECB regulations. ECB regulations do not permit any such deposit from an NRO account. But very interestingly, there is a FEMA deposit regulations where under certain circumstances, you can give deposit to a company on a non-rep basis. So answer is yes, not under the ECB regulations, but under the deposit regulations, it is possible to give a deposit subject to certain conditions. And obviously, as I mentioned, it will be dealt with in more detail. The second condition is,
Is there any reporting requirement?
Answer is yes. There is no formal forms which are required to be filed under the deposit regulations. But as a best practice, it's always good to inform the banker. So while the general conception is that, I need to look at ECB regulations, for a deposit, we actually need to go back to the deposit regulations, which are a bit more lenient. It does not talk about any forms. So what we do is we file a white letter intimation to the banker about it.
Next is, can a private company take unsecured loan from NRI director on non-repatriation basis otherwise than through ECB? Because a private company other than an NBFC cannot issue NCD on public offer.
So you definitely cannot issue NCD, number one. Moment you issue an NCD, you will fall under the ECB regulations. And to some extent, this query is very similar to the first query, where you are actually offering them deposit and you are not calling it as a loan per se. So it's one and the same. I would use that word. And again, there are end uses. There are end use restrictions of what you can do with that money and what you cannot do with that money. So it's very important that those end use restrictions are complied with per se.
Next from Gyan Prakash, Mumbai, a couple of questions also there. One of the partners of LLP is NRI. Can he transfer his share of profit or the credit balance in his capital account to his account outside India?
So a couple of days back, Economic Times reported this. It just came back a few days back, where apparently certain bankers have objected to this kind of a remittance. My personal view is that what can be remitted outside is a current income, and share of profit in a very technical sense is a current income, which can be remitted outside India. So I would believe that yes, a share of profit can obviously be remitted outside India from an LLP. But I want to put certain caveats. The caveats is that you should not be seen as structuring your affairs in India in such a way that you are creating an LLP so that you can take it out, number one, right? So there are certain implied anti-abuse test, smell test, which needs to be made. Second is, at some stage, I won't be surprised if a regulator stops this expressly, because you can't have a scenario where somebody is earning 1,000 crore capital gain and everything is being withdrawn as a share of profit by an NRI per se. So this is an area where you have to exercise utmost caution, speak with your bankers. Are they comfortable, not comfortable? But if one were to look at it fundamentally, if a dividend can be declared by a company and taken out of India under the current account concept, why not a share of profit from an LLP? Effectively, both are at par. I would put it that way per se. But that news item which came few days back in Economic Times is obviously has created huge concern whether this route is at all available or not per se.
And for credit balance of capital, it might not be allowed.
Sorry, Kuldeep.
He actually asked for both a share of profit or credit balance in his capital account. So for credit,
So again, if that credit balance is, normally the credit balance will be in respect of three things. One is it's in respect of his original capital, which is most likely to be on a non-rep basis. So he cannot take it out other than under the $1 million rule, right? So he has, let's say, put in $3 million as capital. Even though that $3 million capital is under the non-rep route, there is a $1 million remittance available where an NRI can take out $1 million out of his non-repatriable amount. So that 1 million is like a regulation which superimposes everything else. The second credit could be his remuneration, partner's remuneration. That's why it's credit. So he can obviously take out a partner's remuneration. And third would be his share of profit. So it really depends on what does that credit composes of. And therefore, what people do it is that they always differentiate between a capital and a current account from an accounting perspective. It's really nothing but a partner's capital account. But if you're able to keep your capital account separate and your current account separate, then your current account will always consist of either your partner's remuneration or your share of profit, which you can freely demonstrate and take it out per se.
The next is, can parents gift and remit any sum of amount to his son who is citizen of USA without any limitation?
See, as I mentioned earlier, citizenship has no relevance. Residency is important. So if the son who is a US citizen is actually a resident in India, right, then they can transfer 100 crore tomorrow. There is no limit. Yeah. But even if somebody is an Indian citizen, right, but that son has gone abroad, he's working abroad, he's a non-resident, then the max which the parents can gift is out of their LRS limit, which is $250,000 a year per se. So citizenship is irrelevant. What is important is residency.
Can an individual remit money by way of LRS from his account by borrowing or receiving gift?
He can't do it by way of a borrowing because somewhere the LRS says that it should be out of his own funds. But if he receives gift, then that gift becomes his own fund. And definitely out of the gift, I would believe there seems to be no issues at all in remitting under the LRS route.
Can money remitted outside India by way of LRS be plowed back to India through FPI route?
So it's debatable. My personal view is that's not the intent. You can't send money outside LRS to bring it back under a separate route under FPI. So I would advise the clients against that. Let me go one step forward. There is this whole debate about can under LRS, can I invest in dollar bonds of Indian companies where the money actually comes in India? And it's a very interesting, you speak with two bankers and you get three views, but if you look at the intent, that the intent is really to use this money abroad, I would use that way, right? Then you'll be careful. You'll say, I really don't know whether I can do it or not per se. So it's a vague, it's a gray area. And I would say generally better to, err on the side of caution per se. So clearly, I don't think FPI route is permissible, but even investing in certain bonds, which primarily invest back into India, could be a question mark, while many are taking a view that it is not expressly prohibited, so I will do it first.
Next is from Shri Jagdish from Coimbatore. Is it possible for a foreign company to transfer professional fee to our bank account in India directly for any consultation given to them? What about the professional fee if we do an assignment in a foreign company, say for an IT security audit?
And the answer is, what I presume is that I'm an Indian firm. I'm an Indian advisory firm or a
Yes,
CA firm. I've rendered services to a foreign company,
outside India.
and whether it is outside India or from India, and the question
Yeah.
is that they are directly remitting the proceeds to my Indian bank account. Uh, I think this happens all the time. I don't see any issue at all. Money is coming in and money is towards services rendered. Whether the services are rendered from India or they are rendered partly sitting outside India, it would not matter. But that's absolutely possible.
It's just export of services.
That's right.
Now from Pankaj Gupta from New Delhi. Please suggest reference guide or book for understanding of Fema and allied regulation. Any reference material we want to know from you?
Yeah. See, as I said, I have great respect for the book authored by Sri Dilip Sheth. That's like a Kanga Palkhiwala equivalent. As I mentioned, the only challenge is that the regulations change so frequently that it's impossible to have a book which covers the latest edition at all. So maybe that's a book which one should refer. And there is one more book. It's called Fema Practice Manual by Taxman. I think I wouldn't be while it's not the best of the books. I would still think for a practitioner, especially an initial practitioner, I think that's a nice book to start with. I do not remember the author's name. I'm so sorry, but it's Fema Practice Manual by Taxman. I'm sure there would be. I think there is a chamber of tax consultant has come up with a Fema manual, multiple volumes, where a topic is picked by an author and they have authored it. Even that's a good manual to house with. I would say that's something more contemporary because it just came back 6 months back. I think that's a must, possibly. I would say. I understand Institute has one or two publications, so I would say have everything. I'm so sorry, buy one book. I would just have everything in my library, and sometimes for a query, whatever works, I would find my answer in those books per se. So these are a few books which I would say recommend for a student to house it.
But majorly they need to be updated from government circulars or RBI circulars, no?
Yes. And see, for government or RBI circulars, it's like the website is absolutely updated of Reserve Bank for decades, right? So just go and check the website once a day. That's it. That's what you need to do. Somebody has to put up a system in its office saying that. There is also a good website known as femaonline.com, where for a subscription you get access to many of these regulations per se. But that's how you will be updated. These are the latest circulars.
And now from Balaji from Chennai, whether an OCI card holder who has come back to India for good can acquire agricultural land by way of gift from his father?
I think if he's an Indian citizen, I see no problem at all. If he's a foreign citizen, there are certain issues whether a foreign citizen, while he's a resident in India, can at all acquire agricultural land. But I'll presume that this OCI card holder will I don't know, take up Indian citizenship at some stage, because most of these OCI card holders are foreign citizens per se.
Yes.
So I doubt a foreign citizen can hold an agricultural land per se.
Now this one from Mailadu Cherian Sajman from Kochi. Suppose A has come to India on tourist visa and stayed in India for more than 182 days in the previous year, whether he is resident or non-resident in India.
Yeah. See, a tourist visa doesn't indicate his intention to stay in India for a long time. So it's unlikely that he'll be granted a resident status by the bankers. If he comes and tells that, while I'm on a tourist visa, I'm actually working, that could be a visa violation. So because then he has really taken the wrong visa to be in India and he could be deported back anytime per se. But I'm presuming he's he's taken the right visa. So a tourist visa doesn't help you signify that you are here for employment or for business or for an uncertain period of time.
Next from Ankush Bhava from New Delhi. Sir, how to access compounding orders?
I think if you just go to Google and just type RBI plus compounding orders, it will take you to the link. Same way, go to RBI website, just type compounding orders. I think it will just give you the link. It's very easy. I don't think, right? It will just take you to the
Search
right
option
link.
is available on websites also.
Okay.
Now from Sandeep Kumar from Delhi, a foreigner is director in an Indian company. He is getting salary from Indian company regularly. But since March 20, he is out of India due to COVID situation. In such case, what will be his residential status for financial year 21-22?
See, this is very interesting, and it happened with few of your clients where you had expat directors who were actually staying in India since few years. When COVID came, they went out, right? But they always took a position. And it's important that they are just waiting for normalcy to come back, and they'll be back in India per se. And in those cases, I have seen bankers continuing their status as a resident, where their savings account were not changed to NRO accounts per se. So if you take a position that, you know what, I'm just waiting for the normalcy to come back, but it's very fact driven, Kuldeep. It's impossible to answer in just this question. The question is that are you coming back? Have you come back? Your subsequent actions also justify or does not justify the position you have taken per se. So if that person actually has come back and is continuing, all the more his earlier action to say that, you know what, I was only temporary outside India because of COVID, I've come back. I think that would be a correct position. So facts would really determine that what is the intention.
Now from Amit Kothari from Mumbai. Mr. X came to India from Singapore on 15th of December 2021. He has still retained his employment pass at Singapore. He has been in India post 15th December to till date. He has been a director in an Indian company and has been working on some real estate projects in India currently. What shall be his residential status as on today, 1st August 22?
See, it's very common, and I've seen it quite frequently, where somebody maintains an employment pass, does not surrender it in a foreign country, but he has taken up employment, and his intention seems to be that, you know what, he'll continue in India for the next few years, etc. And if that is the case here, which prima facie looks like, then, moment he has come back to India, right, he would say, I'm a resident in India. That does not mean I should not continue with the employment pass. Many times an employment pass is an excess, right? I can enter at will and come out at will. But my intention is really to be in employment in India per se. So he can position depending on the facts as a resident, I would say.
As he entered in business line, though might be his resident. Huh?
Absolutely. If he's carrying his own business, all the more, I would say the facts are more powerful. To say that I've actually started my own business, my own company, it clearly shows my intent to be here for a long time.
Now, Pratik from Jalandhar, can a private company accept security deposit from an overseas customer who happens to be a company of a relative of director? Can letter on the deposit be applied as payment for rendering of services to that customer?
Yeah, you know what? This looks like a particular way of, getting money for some time and then applying it towards some services in future, etc. So the two questions in isolation, the answer is yes, but let me just caveat it here that if you're doing this just to get in money, as a temporary funding, which at some stage you'll show some services against which you are rendering it, then yes, I think you are in deep trouble. But if it's a genuine deposit which is being brought in, and one needs to justify as to why will that customer give a security deposit, right? Is it normal in their line of business? So it should look natural. It should look commercially very, very on the right side, I would say. I think then why not? The question would be that can you apply that deposit for a subsequent rendering of services? What we basically do it is go to an authorized dealer and kind of get their consent or approval. So many times the authorized dealer would say, wait a minute, this security deposit is a refundable deposit. But here, if you draft the terms correctly, right, to say that this security deposit will actually be treated as an advance for the services which you are rendering. And these services are rendered within 12 months of the receipt, right? So your appropriation is actually within 12 months. Then I think it's absolutely possible per se. So more than a security deposit, especially where the services are rendered within a year, we show it more as advance because that's straighter. An advance for services to be performed in 12 months is permitted expressly under the export of goods and services regulation.
Next from Anil Madhavan from Chennai. Whether jobs rendered outside India and remuneration received outside India be attracted to FEMA and taxation consequent to this in India? I feel no, but I need your expert view.
FEMA is pretty simple that if I'm a non-resident and as a non-resident I'm working abroad, right, I can keep that money outside India forever. Even when I come back to India, I don't need to bring that money. It's my choice. It's an option, but it's not a compulsion. The taxability depends on my residential status. So if let's say I have worked abroad and somewhere in the month of July I have come back, then for the whole of the year, I become a resident. But if I'm able to become a resident but not ordinary resident, then my foreign source income is exempt. But if my stay outside India is only been for a short few years and I'm not satisfying the definition of resident but not ordinary resident, then even this 2 month salary becomes taxable in India under the whole of what you can say. There you may then try and see whether a short stay exemption is available, which in most cases it is not because it is paid by a local employer. So then you have no choice but to pay tax there and take a credit in India. Right? So the only way out of not taxing that income is becoming a resident but not ordinary resident, right? For which you have one of the two windows, which is like out of 10 years, 9 years, I'm a non-resident, or for the previous 7 years, I have been in India for less than 730 days. There is some mathematical test, sorry. I'm just speaking from memory.
Can a shareholder of a listed company raise an allegation against a CA as CFO and director on the board on any of the jobs done by the said CA as CFO during his term after few years when after the acceptance of the annual report has been filed with all regulators after approval from the AGM? In the AR, there were FEMA points as well as I don't think this question is relevant from FEMA Act.
I don't think it's relevant from FEMA Act. FEMA FSC, so I'll politely excuse this. Of course, one can file any allegations. Nothing can stop you. But FEMA is silent on that.
Now, Vinod Kumar from Delhi. As an individual resident, whether I need to purchase a house for me in a foreign country?
There is no compulsion. If you want to purchase, and let's say you're a resident in India, LRS, you can use it, right? So if I'm getting a house which is, for which I can send the money out under LRS, why not? So there's no requirement that only a non-resident can purchase a house in a foreign country. Even a resident can purchase, but it is under the LRS. But your LRS limits are so small, which is $250,000. So many times you will see multiple family members come together and they purchase a house. Let us say the cost of that house is almost $1 million. A single person can't purchase. So he and 3 of his other family members will put the money out. They will consume their in aggregate $1 million limit, and then they will buy a house. And that house will be in the joint name, which is perfectly fine. So under LRS, yes, it's possible being a resident to buy a house in a foreign country.
Oh, I think we have done with all the questions. And now, on behalf of everyone present there, I want to thank you, sir, for sharing your experts' views on this topic. We really appreciate the time you gave us from your busy schedule, and definitely we want to hear from you again on any next session. And I thank to the technical team, management committee team supports for this session, and CECLA committee, ICAI, to arrange these types of session for professionals. Thank you very much, sir.
Thanks a lot. Thanks a lot, everybody. Thank you.